Storytelling tone, cinematic documentary with an edge of conspiracy thriller, measured narrator voice mounting dread, then clarity. It blends investigative authority with blockbuster tension. Structure, classic three-act, hook, provocative claim plus urgency. Build, historical cycles. Data, ETF physical split. Climax, the stage 5 scenario plus triggers. Resolution, what happens after. Permanent repricing and the moral, be positioned. Pacing alternates long, steady exposition and short, punchy hypothetical scenes to create forward motion. Keywords used: silver squeeze, stage 5, ETF holdings, comics inventory, physical versus paper, mine production, industrial demand, premiums, delivery crisis, Hunt Brothers, retail squeeze. Viewer psychology evokes curiosity. What is stage 5? Fear, loss of supply, price shock, FOMO, position before it happens, and empowerment, you can act. Suspense hinges on the inevitability narrative, plus concrete triggers, thumbnail plus title synergy, titles promise, revelation, plus scale, stage 5, rewrite prices. Thumbnails should exaggerate contrast between paper, charts, and metal, coin bars. Plus a strong short text pull, stage 5, out of metal, 100 plus. This drives clicks from both retail metal speculators and mainstream viewers intrigued by economic drama. They call it the origin story, a slow burn that became sudden, from neglect to coordinated buying, from quiet vaults to shouting markets. At first, silver was invisible. Cheap coins, forgotten bars, margins cut by miners. Between 1999 and 2016, production hit its peak, then stalled. Global mine output never returned to those highs. Production has hovered under 1 billion ounces. Then, the money printers woke. 2008 proved that printing paper changes what people value. 2020 proved printing at scale rewrites markets. When central banks flooded liquidity, investors didn't run to stocks alone. They ran to things you cannot print. Silver responded. It always does. But the real change wasn't price. It was where the metal landed. ETFs and vaults began absorbing ounces. These funds removed silver from circulation. What once flowed through dealers now sat in steel rooms. That accumulation tightened availability. Meanwhile, industrial demand was accelerating. Solar panels, EVs, 5G infrastructure, all required silver's unique conductivity. Industrial usage rose every year. By 2024, industry was gobbling hundreds of millions of ounces. That isn't speculative. It's measurable. It's structural. It's lasting. So the math changed. Mines produced roughly 820 million ounces recently. Industry demanded nearly as much. ETFs held hundreds of millions more. The margins between supply and need narrowed into a razor. And then a telling sign appeared. Deliverable inventories shrank. Comics and major vaults showed fewer registered ounces. Where once inventories could absorb shocks, now they could not. Human behavior amplified the squeeze. Retail communities coordinated. Dealers' sites crashed under demand. Premiums rose above paper prices. Small purchases became a collective force. The paper market, fat with contracts, met the small, stubborn fact of physical scarcity. Imagine 2 lines on a chart. One is paper price, one is metal in hand. For decades they moved together. Now they drift. The gap yawns. That gap is stage 4's signature. This section ends where the original story began, on a threshold. Cycles stacked, inventories thinned, demand hardened. Millions of individual choices coalesced into systemic risk. We tightened the spring, we wound the clock. What breaks that spring? A mine closure, frantic hoarding, or a viral buying wave. One small trigger, one giant unspooling. And then the seam tears.
Stage 2 didn't whisper into the markets. It roared. It was 2008. The year the global financial system flatlined. Lehman Brothers collapsed like a dying star. Bear Stearns vanished overnight. AIG was rescued not by brilliance, but by panic. Trillions evaporated in days. Confidence gone. And in that chaos, silver woke up. Because when fear rises, people run to what's real. Not stocks. Not bonds. Not promises, real, tangible, undeniable. Silver was trading at $9 an ounce in November 2008. But when the Federal Reserve printed $4 trillion, the largest money creation in human history at that time, silver did exactly what real money always does. It exploded. $9 became $12. $12 became $20. $20 became $49 by April 2011. A 5x move in just 30 months. The mainstream media called it a bubble. They mocked silver buyers. They said, it's just speculation. It'll crash just like 1980. And yes, silver did crash. By 2015, it was back to $14, a 70% collapse. But here's what they didn't understand. Stage 2 wasn't about the crash. It was about the reaction. It proved a simple, brutal truth: when central banks print trillions, when currencies are diluted, when confidence cracks, people flee into real assets. Gold moves, real estate moves. But silver moves fastest. Because silver is the most sensitive monetary metal on Earth, small market, high industrial use, and the highest elasticity to fear. Stage 2 exposed the system. It revealed how fragile paper money really is. It was the first signal, the first warning shot. And it set the stage for something far bigger. Something the world still hasn't fully understood. If trillions of dollars printed in 2008 caused a 5x move, what happens when the world prints $18 trillion in 2 years? Welcome to Stage 3, Japan's $12 trillion. Debt crisis is not an isolated event. It is a tremor strong enough to shake the entire global financial system. As the world's third-largest economy and one of the biggest holders of foreign assets, Japan is deeply woven into international markets. When Japan moves, the world feels it. And right now, Japan isn't just moving, it's shaking. The first and most immediate impact is on global bond markets. Japan is the single largest foreign holder of U.S. Treasuries and a major investor in European and emerging market debt. If Japan begins aggressively selling overseas assets to stabilize its currency or reinforce domestic liquidity, yields could spike worldwide. Higher yields mean more expensive borrowing costs, creating a ripple effect that slows economic activity far beyond Japan's borders. The second impact hits global currencies. A weakening yen forces other Asian economies to defend their own currencies to stay competitive in exports. This creates a chain reaction: currency interventions, market volatility, and sudden shifts in global capital flows. Countries like South Korea, Taiwan, and even China get pulled into the turbulence, whether they want to or not. The third and often underestimated shockwave emerges in commodity markets. Japan is one of the largest importers of energy and raw materials. Any slowdown in Japanese manufacturing, retail demand, or industrial production instantly reduces global commodity demand. That means falling oil prices, unpredictable metal markets, and supply chains adjusting with painful speed. Finally, global stock markets respond emotionally before logically. Fear accelerates sell-offs. Algorithms amplify volatility. Investors flee to safe assets, creating chaotic swings across sectors from tech to banking. In short, Japan's debt crisis isn't their problem. It's a global event. Everyone will pay attention because everyone is affected. Japan's debt problem isn't new, but what's happening now is fundamentally different. For decades, economists, investors, and central banks around the world have accepted one idea: Japan's debt is huge, but harmless. The country managed its massive borrowing through low interest rates, high domestic savings, and extremely stable institutions. But that old formula no longer works. Japan is now facing a breaking point decades in the making. The first difference is rising interest rates. For 20 years, Japan enjoyed near zero or even negative rates, which made its massive debt manageable. But the Bank of Japan has finally begun tightening policy to defend the weakening yen and curb inflation. When rates rise even slightly, the cost of servicing Japan's enormous debt pile explodes. What was once affordable suddenly becomes a burden, weighing heavily on the government's budget. The second difference is changing demographics. Japan's population is aging faster than any other major economy. Millions are retiring, the workforce is shrinking, and tax revenues are declining. An economy cannot sustain long-term debt growth if fewer workers are supporting more retirees. The old system, borrowing endlessly while relying on domestic savers, breaks down when those savers turn into spenders who need pensions and healthcare. The third major shift is global economic pressure. Japan used to operate in a world of predictable trade flows, stable supply chains, and low inflation. Today's world is the opposite. Geopolitical tensions, energy shocks, and global inflation make Japan's slow growth model dangerously fragile. And finally, the yen's historic decline is forcing Japan to take actions it has avoided for years. Currency intervention, foreign asset liquidation, and accelerated bond market adjustments are no longer theoretical. They're happening in real time. This crisis is not another chapter in Japan's long economic story. It's a turning point, one that could reshape the entire future of Japan's financial system. As Japan stands on the edge of a financial turning point, the world is watching closely because what happens next will determine not just Japan's economic path, but the stability of global markets. There are three major scenarios with massive consequences. Scenario 1. Controlled stabilization in the best-case scenario. The Bank of Japan carefully manages interest rate hikes while coordinating with the government to support economic growth. This includes gradual tightening, targeted spending cuts, and selective bond purchasing. If successful, Japan could slowly reduce its debt burden without triggering massive market shocks. The yen would stabilize, exports would remain competitive, and global markets would breathe a sigh of relief. But this scenario requires perfect timing, political discipline, and cooperation between ministries, something Japan has historically struggled with. Scenario 2. Market disruption and forced intervention. A more likely path is one where markets react before policymakers do. If investors lose confidence, Japanese bond yields could rise sharply, forcing the government to intervene aggressively. That might include emergency bond purchases, currency interventions, or even selling U.S. treasuries and foreign assets. This would ripple across global markets, pushing up interest rates worldwide. In this scenario, Japan doesn't collapse, but it enters a period of financial stress that slows growth and creates instability across Asia and beyond. Scenario 3. Structural reset. The most dramatic scenario is a full-scale economic reset, where Japan is forced to overhaul its decades-old economic model. This could involve major tax reforms, large-scale privatization, labor market restructuring, and a shift toward productivity-driven growth. This is the most painful route, but also the one that positions Japan for long-term survival. All three scenarios share one truth: Japan can no longer rely on old solutions. The decisions made in the next 12 to 24 months will shape its economy for generations and send shockwaves through the global financial system. Japan's current debt crisis is not just a national emergency, it's a global warning sign, a preview of what many advanced economies may soon face. Japan is simply the first domino in a chain built over decades of cheap money, aging populations, and government overspending. What makes this moment so important is not that Japan is struggling, but that Japan is showing the world its future. For years, countries like the United States, the UK, Italy, France, and even China have followed a similar path: rapidly growing debt, low interest rates, and reliance on central banks to keep borrowing costs suppressed. As long as rates stayed near zero, the system survived. But now the era of cheap money is over. Inflation is back. Interest rates are rising globally. Demographics are worsening. Japan is simply the first major economy to hit the breaking point. The core warning Japan sends the world is this: even wealthy nations can run out of time. Even strong institutions cannot escape the math of compounding debt. And even the most stable central bank cannot control markets forever. Japan is also demonstrating how quickly a slow-moving crisis can turn explosive. For decades, analysts said Japan will be fine because its debt is domestically held. But now that aging citizens are withdrawing savings and the yen is collapsing, that assumption has shattered. Other countries with similar demographics, South Korea, Italy, and even China, are watching nervously. Perhaps the biggest global lesson is emotional, not economic. Market confidence is fragile. Once trust breaks, everything accelerates, currency declines. Bond yields spike, capital flees, and governments lose control of their financial destiny. Japan's debt shakeup is not an isolated event. It is a preview, a mirror, reflecting the challenges that will soon confront the entire developed world. If this breakdown opened your eyes to what's truly unfolding behind the scenes, then don't stop here. Hit like, subscribe, and turn on all notifications. Because the next chapter of this global financial story is already being written. Nand, you, Dan, T, want to miss it. This isn't just news, it's your financial survival guide.